We're going to start the Optionsmith webinar with Steve Smith. Steve Smith is the author of the Minyanville Optionsmith report. He's been smashing the S&P 500 for about 3 years. He's a very modest guy. He doesn't like to brag. When he brags, he talks about not losing money, but he's really good at making people money without doing anything stupid, with pretty easy with options. Very, very risky. He's been trading for over 20 years, was a seat-holding member of CBOT and CBOE. He was a big guy, options guy at TheStreet.com. He won Best Business Newsletter from Min, and that's the place that does Best of the Web. So it's not a garbage award, it's a real award. So Steve is a very big guy. We're very honored to have him here. You know, I go way back with Steve. Every time I have a bizarre options questions, he's always able to answer it. So we think we're going to have a great show today. So everyone, this is Steve Smith. Steve, please say hi to the people.
Hello, everybody. Oh, now I hear myself. Okay. Great to be here. I appreciate you inviting me in, and hopefully we'll be able to cover a lot of territory, and that it'll be useful for everybody. So, you know, I'll let you handle the direction. We kind of know what we want to map out, how we want to talk about options. So.
Okay, all right, let's just pull back, take a big view. I mean, why should people care about options? Option volumes, they've held up pretty strong in the past few years, at least relative to equities. So first and foremost, why trade options?
I think that first and foremost, we need to, options for a long time had gotten a bad rap, that it was, you know, even worse than the equity market as far as a rigged game. And early on in my career, that was true because it was a matter of access. Who has access to the information? Who has access to the ability to trade? Now, it could be further from the truth. It's a very transparent and flat market, and it's great for retail traders. The spreads have come in. You have electronic trading. So in terms of that, why you would want to use them? Because simply put, as everybody from me and everybody else always says, it's a risk reduction and able to expand profit potential. So you're getting both sides of the coin: protection and maximizing profits, with, you know, making sure you use the leverage properly. And that's what we're going to try and explore today: is making sure you understand how you can use it properly. So, like any tool, use it properly. It can be a great benefit.
Okay, so let's just take it from the top. I think people associate options with just pure speculation, like buying a ton of calls at Apple or whatever on the anticipation of an iPhone or something like that. So, I mean, first and foremost, how can people avoid, like, basically killing themselves with options?
So that's okay. That's a great starting point. Is that a lot of people come into options and they look at them as lottery tickets, and that's not going to work for you over the long term. You know, whether you play the lottery or it just so happens we were talking. You know, what we want to do in the course of our discussion is look at options as it's a way to get probabilities in your favor rather than possibilities. So the probability of something happening is much more important than the possibility, which would be the black swan, would be or the lottery ticket. So to just go buy a bunch of out-of-the-money lottery tickets, you know, is probably not going to pay off. To work and get consistent returns is putting on positions that you've analyzed and are going to have not as big a return, but a consistent return. So, you know, I was just talking to you before we came on. You know, I actually played a game of poker last night, and let's say in the course of 50 hands, I won 5. So I only won 10% of the hands. You know what? I came out even. Why? Because I managed my risk, and that's the first starting point of any trading, and certainly with options, is managing the risk, knowing where your entry exit points are, what your, you know, what the benefit may be, what the maximum profit may be, what the maximum loss may be.
Okay, all right, let's move on. The VIX has been a big topic of discussion. It's about 13 right now. It's picked up the last couple days. Now, on a historical basis, it's at very, very low levels. I mean, when you look at a long-term chart of the VIX, you basically see 13 is more or less near all-time lows. Now, what do you think of that?
I think that a lot of people are misconstruing what 13 right here means. If you want to go back and put it in a historical setting, is the rise up to 80 during the financial crisis was an anomaly. but more importantly, to give it more of what the analogous situation might be, is from 2005 to 2006, there was a year where the VIX stayed in the 12 range, and the market keep drifting higher. And that's what we want to get into in a little bit. This is implied volatility. The real volatility of the S&P 500, which the VIX is based on, is actually trading about 7. So this is more than double. There's a huge premium still. So the VIX is the implied volatility of options on the S&P 500. So there's still a big premium based on after the fiscal cliff came and passed. Once that drops off, when you measure it on a 30-day basis, you're going to be the 10-day moving average is 4. So a 13 number is not cheap by any measure, and it could stay there. It could it could stay there indefinitely. It's not a measure of complacency at this point. So I wouldn't use it as a reading of complacency. If you want to use it at all, it's relatively on a notional basis, it's inexpensive. So if you need portfolio protection, this may make sense to use puts or buy calls on the VIX or something like that. But it's not cheap by my measures at this point.
Okay, so let's jump into portfolio protection for a second.
Yeah.
So would it be better to actually bet on a rising VIX or just put options on the SPY or something like that?
I used to be somebody who stayed totally away from all the VIX-related products, whether it was VXX and the inverse and leverage, just because they become derivatives of derivatives and they're kind of complicated. But recently I've started to use them a little bit, just that if you buy VIX options or options on VXX, some of the ETNs that are based on the VIX, is you're not anchored to a strike price. So let's say the S&P goes from 150 up to 154. The VIX may still only hover around 13. So you're not necessarily moving further out of the money, whereas if you bought S&P or Spider puts, which will be that much further out of the money. So in that sense, there's something to be said once you get down to these levels to using the VIX and its related products as a hedge. But for the most part, it hasn't worked. They've been overpriced for 2 years. These things, so it hasn't worked as a hedge.
Okay, I just want to remind everyone, if you have a question for Steve, we can get to anything you want, so just put your question in the Q&A section at the bottom, and Steve is more than happy to answer anything. He knows basically everything about options. Every harebrained scheme I come up with, he busts. He busts me every time. Okay, so we're going to move on to a big topic that's specifically related to earnings, and that is the concept of let's say you bought calls on Amazon ahead of the earnings report. Spikes huge. You look at your statements the next day, and you actually lose money. So how does that work? How does that work, Steve?
All right. So this is one of the big issues about using, in terms of options and understanding what goes into their pricing and how the price behavior works. And volatility is probably, so important and probably something that people don't understand. And volatility is, again, it's different than if we want to go back. If you look at the VIX and you say it's 13, it's low. But what's the real volatility? So you have to understand implied volatility versus what the real volatility is. Implied volatility is what people are expecting going forward. And in this case, Amazon was pricing in something like a 12% move. And, it covered a lot of ground, but after the first hour, it was basically, I think it was like a 7% move. So if you took a look at the, 275 calls, you ended up losing money. And certainly any call above that, you ended up losing money. So, and a lot of people use options and they say, wait a second, I had it right, it went up. but it didn't work, and they say options don't work. Well, you have to understand how options are priced and how it's going to work, and that's going to lead towards what strategy do you want to use. You know, how are you going to value an option? You know, so you don't have so you're not disappointed. And again, that goes back to the probability of if something's already priced in, then you can't pay for some. You're not going to make money if exactly what's priced in is that outcome. You need to find what's not priced in, or what's going to give you an advantage for what you think is going to happen. So.
Okay, so you know, very often people use an insurance analogy for option. Now, is it fair to say that ahead of earnings, insurance is very expensive because big move is likely to come? Is that the way people should think of it?
Yeah, I mean, earnings are kind of a special situation, you know, but overall, for sure, options are priced as insurance. And so, again, you would go back to, if you want to do probability, you know, the seller of insurance over the long term probably makes money. But if they take a hit during a hurricane, or whatever it may be, or, you know, in terms of stocks, an FDA report or crazy earnings report, they may lose what they gained over 10 months. But yeah, so, you know, again, it's probability in choosing the right strategy. So in the Amazon case, which you have up on the board, is just buying insurance really didn't work in the long run, even though there was a violent move up and down. Again, it turned out to be the seller of insurance, because they were able to price it high enough to say, well, we don't know what's going to happen. And the sellers ended up making money.
Okay, we already have questions coming in. All right. First of all, can the VIX go to 0? Is that possible?
If they shut the stock market down, yes. Otherwise, no.
Okay, we have another one. If a trade is going,
I would say, just to follow it, not to be flip about it, I think we found that 10 is, well, we're already seeing the lowest real volatility at about 5%, and there's always going to be a premium. So I would say anything on the VIX at 10 is about the floor. So.
And just to be clear, is it really low now because basically the market's kind of stair-stepping up? We've had 12, 11 to 13 updates, something like that. Is that possible?
Yes, it's a combination of real volatility versus, I don't know if you can see my hands, not trying to find. Real volatility is extremely low, and we've already passed through. Then implied volatility, which wants to measure what the expectations are, is we're past the cliff. That's it. There's nothing wrong in this universe anymore. So you're seeing that nobody needs to pay up for the optionality of some huge move.
Okay, all right.
Steady.
Well, let's move on to the next question. If a trade is going against you, at what point do you think about getting out or adjusting or things like that? Like, do you have any specific methodology for dealing with those types of situations?
I think I like to enter every trade with a target price and a stop loss price. But when you're using options, and this could cut both ways, depending on the time and the price, you may end up fudging those, such as if the price moves in your favor very quickly, you may say, you know what, I'm going to take the profit now, and you'll end up leaving money on the table in a way, because assuming you're using a spread. If it moves against you quickly, you may say, you know what, I'm out, or you may end up saying, you know what, there's still time left for this to recover it. You don't want to get sucked in. So I do like to set up where I have target prices and keep the discipline of that. So I should leave it at that.
Oh, okay, and
you know what?
just to be clear, when you have a stop loss in an option trade, do you think about it on the price of the underlying stock or the option?
Yes, not the option. Underlying, yeah. So the only time, so it may become fuzzy, is if there's only a week left and it still hasn't stopped you out in terms of the underlying price, you may say, you know what, I'm just going to leave this because you know, it's already 15 cents. What am I going to do with it? Maybe something wonderful will happen. But basically, I want to use the underlying stock as my gauge.
Okay, we have more questions. How does the VXX relate to the VIX?
It is a ETF that tries to construct and track the VIX, which is a compilation of 30-day options. So it uses both the front month and the next month, and a mix of the prices to get that number, the VIX. The VXX does that, but they're continually rolling, and because the VIX is typically in contango, where the later months have a higher price, it has a downward pressure on it. So all things being equal, over time, the VIX is going to drift lower. The VXX is going to drift lower. So that's why I used to stay away from it. And you know what? Honestly, I bought some VXX calls 2-3 weeks ago, and it's just been pressured. You can see it in the chart. So they're tied, but the like a lot of these products, whether it's the USO, anything that's related to futures that has a rolling aspect to it, is going to have a downward bias, because they're usually needed to roll forward and buy higher price futures that then need to revert back to the cash price.
Okay,
So,
okay, all right. Well, we're getting a lot of questions. We appreciate them. Just keep coming in. We'll get to as many as possible.
And I'll try and be quick with my answer.
Okay, very quickly then. Do you ever try to make money off selling out of the money puts or calls?
Not naked. I learned my lesson with that.
All right, and just for the beginners, what does naked mean?
It means you can earn only what you sold, so you can sell a put or a call for $1, and if it goes against you, you can lose unlimited amount. I learned my lesson back in 1991 when United Airlines went bankrupt, and I was short some puts that were $50 out of the money, and with 1 day to go, and the next day I had to buy them back at $50.
Well, so that certainly explains a lot. Okay, all right, how often do you sell straddles into earnings?
Not frequently, no.
Okay, all right.
As far as earnings, I'd rather take that because it's such a spec play. I'd rather use a butterfly spread and try and and risk a little to make a lot, as long as I'm really, you know, that's such a speculative thing. I'd rather get the odds in my favor than, you know, unless something's so pumped up. So I'd rather do something that's directional for an earnings play.
Okay, all right. I think that's pretty much it for now for questions. All right, let's move on to strategies now. Let's go to the calendar spread.
Okay. So like all spreads, the main idea here is that by buying and selling something simultaneously, you're reducing some of the inputs in terms of your cost and defining your risk. So you're offsetting time decay, you're offsetting changes in implied volatility, and the offset is that the upside will usually be limited. So in a calendar spread, the idea is to sell something that's in the front month, to sell something that's going to expire sooner and capture that accelerating time decay and reduce the purchase price of the later dated option that you're buying. So let's see, so we have an example of an IBM. You could go right at 205, which is about where it's trading, and reduce your cost to a net debit of $1.40. And your best scenario would be is that if it ends up at 205 on the February expiration, and then you're basically net long the March call. What I do usually, which is fine, it's kind of a neutral strategy, and it's very much about time decay. What I do with these is usually try and twist it a little bit to give a little bit of maybe buy a lower strike, and so you have a little bit more of a directional move here. This, as I said, this is delta neutral at the moment. So I like to do this, get the time decay in my favor, but also get a little bit more of a directional bias. So.
Okay, all right. We have a very good question here, especially since it's earnings season. So, if you have a position on and a stock gaps against you, it most likely because of earnings or merger or something like that. And how do you deal with a situation like that? Do you just eat it up at the open? Do you try to hedge in after hours or anything like that? Like, how do you handle that?
I would never do anything at the open. I would never do anything at the open. You know, and then you have to take a look at the situation. How much time is left in the option? Where did it just plummet to zero? Well, you know, if it's 10 cents, you know, it's already written off. If there's still value left, then you do have to make a decision. And really, you know, I would probably honestly need more information about what it is that changed, what caused the gap. You know, is it a squeeze? Is it an Herbalife squeeze that may subside? Was it a complete? Was it a takeover bid that it's not going to come back down? You know, was it an FDA decision? So I think you need to look at it case by case. There's no, you know, I'm not big on repair strategies. You're essentially wrong, and to try and do something to cover up what didn't work out may just complicate the situation. So I think you need to look at what were the circumstances that went against you, and you know then take it from there. Rather than, I don't think there's an overall like repair strategy for like, all right, this went against me. Now what do I do?
Okay, getting more questions. Okay, all right, how do you think about out-of-the-money options as for making directional bets?
I think there's a time and a place for them. You know, certainly, you know, if we want to talk about, you know, here it was RIM today, you know, ran up, and there's still true believers that say RIM's going out of business. You know, you would have done fine. You probably could have bought some $12 puts for not so much money, you know, for 20 cents, and they've probably doubled today. So there's a time and place for them. It's not my thing. You know, I want to be a grinder. I want to be someone who makes 3 or 4% a month. And there's a place for that, but you're not going to make a living just doing out of the money things. Identify opportunities, and that'll, as I said, that can add alpha to your portfolio by doing things like that.
Okay, we're going to move on to the next strategy, which is basically the plain old vanilla spread.
Okay. Yeah, I mean, this is just something about spreading to identify exactly what the trade is, your risk and your reward. So reducing cost, defining the profit, defining the risk, and you know, so it gives you a chance for your thesis to play out. You know, the trade-off is, as opposed to owning the underlying, is that if something moves sharply, if I have a March spread and something moves into the money completely in the next week, I'm not going to get that maximum profit because the out-of-the-money call is going to still have time premium. So that's the trade-off. But what it is to understand is this is the way to build consistency. And you know, we didn't get into the Greeks and this and that, but understand how you can build a position and understand what the delta of the position is and how that's going to change over time. And the delta is basically a measure of how much the options price is going to change relative to the underlying price. So an at-the-money option is going to change 50 cents for every dollar change in the underlying. So, you know, understand that, so then it's about having your expectations and then managing the position. So you're not going to maximize your profit here. You're not going to be able to sell this for the full $5, but you will have a good return. You could have a very healthy return of 30–40% in a matter of a month if you were right, without the same risk of owning the underlying. So
Okay, all right. We have another very good question. If you have a trade go against you and it's basically nearly worthless, maybe just trading for pennies or something, do you just cut them loose, or do you let them fly to expiration just in case a big event comes and pushes it back in your favor? Are you in favor of cleaning out the books, or
Yeah,
just hanging
if
on
it's
for a bit?
pennies, if it's pennies, I would say just leave it because, depending on what your commission, there's no more downside. So if it's 10 cents, I mean, unless you have thousands of them on, something below 5 cents is not is something that you never know. So I would say just leave it.
Okay. Somebody put in a question.
Certainly not on the flip side of it. Something very, very important. If you short that part of it, let's say you had a spread and you short, one of the things about spreads is, let's say I put on this spread that's still on the board, and market came down, whatever this security was, came down quite a bit, and the one I was short went down to 5 cents. Of course, I would cover it, and then I have, because there's no more, there's nothing else I can wring out of it. So cover the things that are that cheap. If you're long it, well, it's just, might as well keep it.
Okay, all right. I think that's a good distinction. Let's move on to butterfly spreads. Before we get a question, we had a question on them. So why don't you tell us about butterflies?
All right, butterfly spread. So we did the vertical spread. A butterfly spread is basically two spreads stacked on each other. You're buying a vertical spread, and then you're selling a vertical spread, and the strike in the middle, that's what's in common. And these are very low cost. You can see from the example, right? So we're paying 20 cents, and we have the possibility of making $1.80 in the SPY example, right? So these are great in terms of low cost. So you can do these in relatively big numbers. The downside of these is that because everything's so offsetting, you really can't take it off for a profit until you get very close to expiration. So this is when it becomes a little bit of, let me try and figure out where we're going in what time frame. And but it's an inexpensive way to get great leverage. So let's say I wanted some basic protection in the S&P over the next 2 weeks. That's going to pull back 5%. So 147 is going to be my maximum profit, right? So I can do something like this. I actually use these quite a bit for earnings reports if a company's reporting earnings, and you use the weekly options, or if it happens to be, because you can get a 1 to 8, 1 to 9, 1 to 10 risk, reward to risk payoff. But you need to be exactly right. You need to basically land the number. It needs to be at 147. In this case, the SPY, it needs to be at 147 on the expiration date. But you can only lose what you paid, which is 20 cents. So again, it's about probability. So
Okay, I have a related question. Do you believe in the concept of pinning? People often say going to expiration, Apple's going to be pinned at 500, Amazon will be pinned at 250, whatever. Like, do you really buy into that?
I think there's some of that. I think it's been diffused a bit by the introduction of weekly options, because the open interest is now across different time frames, especially for the most actively traded. But remember, I would say in terms of pinning, it can gravitate, or options they do because people need to, it needs to go there. Well, let's say it falls through, let's say there was Apple, you brought up Apple. What probably might have happened is as it falls through a strike price on a Wednesday or a Thursday, you have people needing to cover. Suddenly, like, a magnet can either attract or repel, and suddenly you have people who need to cover the people who had sold puts, sold Apple 450 puts on Thursday of last week and thought, oh, it's going to hold here. Well, guess what? It broke through there. Then it accelerated down and went another $10. So you may see some of that. So I think there is a force that you need to acknowledge, but I don't think that it's something that you want to use as a trading mechanism to say, I'm going to play the pin. because again, it can end up repulsing. You know, depending on the price action, it could be it can repulse.
Yeah. So I mean, basically, I was wondering if you believe in the pinning phenomena, like are butterfly spreads the best way to do that? If you're convinced that some stock's going to land in some price at the end of the week, would that be the way to do it?
You know, that's I would say that, you know, you may start with, when you establish the butterfly spread, you may start with saying, ooh, where could this end up? Where's, you know, where's support resistance? Where's open interest? Where may it gravitate to? But, you know, you'd probably end up just being lucky if it really ends up there. But I think that's in a way, could be a good navigational tool about what strikes do you want to use in setting up the butterfly, is where, you know, where can this end up in terms of both the technicals, the open interest. So again, as most things, you want to use a couple different things. I don't think you want to just simply say, you know, this is likely to pin here. And again, you're probably more likely on the butterfly, you're not going to land it. You know, I've made money on them, but I've rarely ever landed one exactly. So.
Okay, all right. We have a related question. All right, on the SPY trade, if one leg is in the money, do you need to close it out pre-expiration, or does it settle in cash?
No, you don't need to. Everything's auto exercise, so you definitely don't want to close out the one that's the long in the money, because then you're going to be short. You're going to be short. Which is not what you want to be. You know, you're going to be naked short a number of contracts. So no, I would let if you want to close it out, you got to close out the whole thing. If you want to let it go to expiration, it'll be auto exercised. That if one is in the money, that's fine. You won't be long the stock. You'll say, I don't want it. If two are in the money, then they'll offset each other. If all three, then it's all offsetting. So.
Okay. Why don't we move on to the last strategy, which is the backspread.
Okay. This is something that would take advantage of a sharp increase in a sharp move and an increase in volatility. So what you're trying to do here is, and it's best put on, you know, now we're in environment, right? There's very low, the volatility is very low. So this is something you want to sell something that's basically close to the money or in the money, and then buy a greater amount of contracts that are out of the money. So the example I gave here is in the spider, and you could buy almost four the 149 puts versus just one, versus selling just one of the 151 puts, and it costs you what was it? It was minor cost of like 16 cents or something. So you immediately have a position that's short, but the key to this is if the SPY starts falling, you're going to get increasingly short as it goes down. That meaning your delta is going to continue to go higher as the market goes down, and you're also going to get the benefit of that on a declining market. It'll probably have a spike in implied volatility. So this is, you know, this is again about choosing the right strategy to match your investment thesis. So I'm not endorsing this right here, but it's cheap, and that would be another way to give, you know, if you wanted to have portfolio protection, or you think, hey, everybody's crazy, what are we doing up here at 1500, blah, 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 you know what? So if you think there's going to be a big decline somewhere in the next couple of weeks, using a backspread is a good way to go. The one thing you'll see, the numbers won't work the same if you look at the numbers for a company just before earnings.
Hello?
Like, I'm not sure, you know, whether it was Amazon and tonight we had Facebook, you wouldn't be able to get that same ratio. You'd only be able to get for 1 for 2, not 1 for 4 in terms of what you sell to finance what you're purchasing. So that's because of the volatility. You want to put on backspreads when volatility is low. So these are kind of like something that you're, you know, call it a black swan that you can put on, and they really perform best when something dramatic happens.
Okay.
Does that make sense?
Yeah. Basically, this is the worst kind of insurance for the worst outcome or best outcome, I guess, on the other side of it.
You know what? I've used them. I wouldn't use that as overall portfolio insurance. You know, maybe you could, but it's something to keep in mind. As it's you know, opportunistic. I use them. You know, you see sometimes the opportunities come up, but you know what? Even the SPY right now, it's not a terrible thing to do.
Oh, okay. Well, let's just pull back for a second.
You'll pay for your insurance. So.
Okay, I'll just remind people we're going to be wrapping up pretty soon. So if you have questions, get them in now. And don't worry, the webcast will be available later. We'll also have the PowerPoint available, so you won't miss anything. But if you have questions, get them in now. But let's pull back for a second. Now, as an options guy, how do you look at the market environment now? We have the low volatility, lots of cross currents with the economic data, and we just came up with Europe, fiscal cliff, and God knows what else is right around the corner. I mean, like, how do you think about structuring options for a portfolio like around this time?
I think, in terms of portfolio construction, it's something that, in terms of my newsletter, I would say that should only be 10% of your, it's a fairly active traded thing. So in terms of your overall investment, if it's an actively traded options thing, maybe only 10% of your overall portfolio. How am I approaching using an options portfolio? Is like everybody else, it's tough. The intellectual case is to be bearish because there's a lot of problems. The reality is there's a lot of bullish things going on. Zero interest rates, improving data from housing certainly. But how do I drill down? It's always about probability. I try and balance the portfolio and basically structure it as a big married put. That is, I'll have some kind of spider put protection and against a certain number of longs and one or two what I would consider strategic short positions. So you try and be balanced and keep your risk, manage your risk. So
okay,
I don't have in terms of big macro theme, more people and smarter people have opined on that, and I do that occasionally in the newsletter, and I can't say what's going to be. I can only trade what's in front of me.
Okay, folks, we're going to wrap it up with one last call for questions. So, Steve, before we end, like, what is one thing people can do to improve their options trading? Like, if you can give one piece of advice to help people either make more money or stay out of trouble, what do you tell them?
I would say, really, learn volatility. Just understand what the difference is between realized volatility and implied volatility, and what that means in terms of the price of the option. Some people will argue, there's no bad deal, there's only a bad price. So if you want to think of it that way, you know what? If you buy an option at a good price, at least you're only jumping out of the ground floor window. Or conversely, if you want to do something where you're generating income and you're selling options, make sure you're selling something from the penthouse that's very inflated. So understand volatility in the price of the option.
Okay, all right. We have another question. Do you ever use long-term strategies that are based on price action, like months into the future, or are you mostly short-term?
I'll go out 3, 4, 5 months. Not much beyond that.
Okay.
So mostly it's something that I'll use a 30 to 60-day option, and then depending on what the price is, I do a lot of I will adjust and take profits and try and harvest things, because again, it may sound modest, but 3 or 4% a month, that's turns out to be pretty good year.
Okay, let me remind people, if you have any very basic question about options, like what is implied volatility, stuff like that, just go to Google, search Steve Smith, and 9 weeks. Well, we put a bunch of article series up on Minyanville.com where Steve runs the gamut in options education. So you know, you can find all that stuff there. So one more. Do you ever use quarterly options?
Yes, I like the week. I like that they've added all. You know, that you be selective. Sometimes they come up and you have an event, and it's nice to know that you have something that the time aligns with your what you think may happen in terms of the price prediction. There's always time and price. So using something like that is great. That they have more listings. I'm not against it.
Okay, Steve, we're going to wrap it up. You know, I think everybody wants to go home for dinner, so we're going to wrap this up finally.
Thank you so much, Michael. This has been a pleasure. I hope, you know.
Yeah, we put the email address on the screen. If you want to contact Steve and harass him, you know, feel free. He's been taking mine for years. So, you know, never hesitate to get in touch with us. We want to thank everybody for attending. And, of course, Steve, thank you for your time.
Thank you. I enjoyed it.
Okay,
Thanks.
bye, everyone.